Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. Coming up on the program today, Ghana's inflation rises to 10.4% in December 2020 from 9.8% recorded in November. And Kenya's electricity fuel costs levy jumps to 13-month high. Plus, South Africans brace up for blackouts as Eskom resumes power cuts today. We'll begin the show with market numbers from major African markets we track, and starting off here in Nigeria, where the main index reversed its positive trend at intraday, falling 0.66% owing to declines from industrial goods heavyweight Dangote Cement. On the flip side, other markets we track were positive. South Africa's JSE index rose 0.31%, while the EGX 30 in Egypt added 0.24%. In Kenya, the market closed negative on Friday. And investor sentiment in the Middle East were deep in the green territory at intraday. Abu Dhabi's index posted a whopping gain of 3.97%, while Dubai's benchmark index jumped 1.6%. Elsewhere in the region, Saudi Arabia's main index added 0.42%, while the Qatari index was marginally higher by 0.02%. And in Europe now, stocks started the new trading week slightly lower today amid a pullback in global markets. All right, let's get more update from Chelsea, the Frankfurt Stock Exchange. Hello, Chelsea. A beautiful week to you. It's a new week, of course, and Germany is once again bracing for tougher lockdown measures ahead of a meeting tomorrow between German Chancellor Angela Merkel and state leaders. How are investors reacting to this?
Investors are obviously a bit worried about what exactly is going to come out of this summit tomorrow. It seems pretty clear that we will see both an extension of the current lockdown that was set to expire at the end of this month. There are a lot of different ideas floating around, but likely it will take a couple more weeks of lockdowns that we will be seeing here. There's also a big discussion right now about potentially introducing new curfews in hotspot areas, as well as trying to get more and more people to work remotely. This has been quite a slow process here in Germany. Only about 14% of people are working from home right now, and that's despite more people clearly being able to work from home. So that's a big concern as a potential source of the outbreaks. But for investors, they are concerned that we are going to be, looking at several more weeks of lockdown measures. Here in Frankfurt, the DAX is about flat. But tomorrow we will see exactly what these state leaders and Chancellor Merkel decide, and there likely will be some economic damage, especially to these sectors that have already been suffering, like the hospitality sector, the retail sector, as well.
And in the meantime, a global shortage of semiconductors continues to roil manufacturing around the world. How are German automakers being impacted?
This is causing some major headaches for Germany's auto sector. We're really seeing this play out across the world. There are not enough semiconductors. This is due in part because there has been this explosion in demand for consumer electronics, things like laptops, phones. So that's really where the priority is being given to the existing supply of semiconductors. That means that a lot of automakers aren't getting the chips and the technology they need, and many are having to cut production. We've seen Audi, for example, here in Germany, say they're going to have to put about 10,000 workers on furlough. Volkswagen has also said they expect to produce about 100,000 fewer cars in the first quarter because of this. And we've seen other automakers like Ford shutting down plants here in Europe as well because of the existing shortage. They just can't produce vehicles because they don't have the technology they need. As well as that, many are saying they expect the shortage to last for at least a few more months. It likely will take quite a while to really work through these shortages. So that is a big blow to automakers that are already reeling from a really disastrous 2020.
The auto industry has a new giant. France's PSA and Fiat Chrysler completed their merger over the weekend with a new company, Stellantis, now the fourth largest automaker in the world. How are shares trading in their first day on the market?
It was really a blockbuster debut for Stellantis. The stock opened up in Paris, where it's traded about 3%. It's actually up even more now, about 5%. So investors really looking at this merger quite positively. And there had been a lot of concern coming into this about the future of both of those companies, because the auto industry, aside from all of these short-term concerns like the semiconductor shortage or the coronavirus, they're really looking at a very difficult future, because many are having to shift from diesel engines, from oil-powered engines to electric vehicles. It takes a lot of money, a lot of investment, a lot of research, and really only the biggest players have those resources. So for PSA, for Fiat Chrysler, they had really fallen behind in this global race, and now a lot of investors are quite optimistic that together they will have the resources to really become a major player in the auto industry in the future. So that optimism definitely being reflected on stocks today.
All right, Chelsea, let's keep an eye on that summit tomorrow, and we'll talk again. And in London, the FTSE 100 index made a very subdued start, down 12 points in the morning. Let's see what has changed this intraday with Juliana. Hello, Juliana. Good afternoon. Well, UK property companies and builders are rallying, with travel companies dipping. How have these shaped the direction of the equities market this intraday?
Good afternoon, Chimezie. As you said, it's not a great start for the internationally focused FTSE All-Share at early trading and at intraday. It seems to be the oil majors and airlines that are dragging down the FTSE. BP and Royal Dutch Shell, they're both down 2%. That's because oil prices have fallen. And then, of course, because of this new government ban on travel corridors, which came into fruition today at 4 a.m. That sent the IAG down 1.9%. Also on the FTSE 250, even though that's trading higher at intraday, EasyJet fell 2.5%. So the numbers, the FTSE All-Share is down 0.08%, the FTSE 100 is down 0.10%, and the FTSE 250 is up by 0.11%. In the currencies market, the British pound is down on the US dollar by 0.31%, down on the euro by 0.18%, and down on the Japanese yen by 0.40%. Down at intraday.
And shares in telecoms operator BT, down, dropped by over 2% this morning after it was hit by a £600 million compensation claim. Tell me about this compensation claim.
Yeah, this is an interesting story, one that goes back to 2009, and it mainly affects elderly customers, about 2.5 million landlines. A lot of people here in the UK, when you're buying a landline, if anybody ever uses it, you typically would buy it with a TV package and a broadband internet package. And so what BT were doing, even though some customers were not buying it with the TV and broadband package, they were still being charged for that. This was flagged up by Ofcom, the telecommunications watchdog, in 2017. And what BT did is they then reduced the monthly landline fee for all of those customers by £7. Campaigners are not happy. They say it hasn't gone far enough. And now there's a law firm called Michon de Reya. They filed a claim with the Competition Appeals Tribunal to the tune of £600 million. And this would mean that every customer that's been affected would be able to get £500 compensation. Now, BT are really not happy about this. They say that they've done everything that they can, and they said they're going to fight off this case pretty viciously. A spokesperson for them said, "We take our responsibilities to older and more vulnerable customers very seriously, and we will defend ourselves against any claim that suggests otherwise. For many years, we've offered discounted landline and broadband packages in what is a competitive market." So they're clearly not happy. But as you said, shareholders are running scared, which is why at intraday their shares are down by over 2%.
And the stamp duty holiday is expected to end on the 31st of March, and report says home buyers face unexpected tax bill. Now, is there a rush now to buy a house before the tax holiday ends?
Yes and no. I think the rush is really coming from house buyers. Rightmove, which is a pretty popular online property portal, they have realised that over the past 3 weeks, asking prices have dipped by about 0.9% because, of course, the market are really keen to try and get as many customers or house buyers in as soon as they can before the stamp duty is back on. That comes back in place on the 31st of March. But the issue is, which is where this hidden tax cost is coming from, it's just taking so long to dot all the I's and cross all the T's before you can buy a house here in the UK. It typically takes about 4 months. So really, if you're thinking of the date we're at today, if you were deciding to buy a property tomorrow, it is really unlikely that you would be able to sign, seal and be moved in before the stamp duty comes into place. So what a lot of experts and property dealers are asking people to do is just to make sure you put that stamp duty tax as part of your savings, because unfortunately time has really run out for you to do a quick deal and save, for some people, tens of thousands of pounds before the deadline comes to an end, Chimmy.
Well, I was thinking you were going to tell me you were planning to buy a house there. Juliana, let's keep a track on those data we're expecting for this week. I'll talk to you tomorrow.
Talk tomorrow.
And shares in Asia Pacific were mixed today as investors in the region reacted to Chinese economic data, including the country's GDP print. For the fourth quarter, China reported its GDP rose 2.3% last year as the world fought to contain the coronavirus pandemic. The broader Kospi index in South Korea led losses among the region's major markets as it dropped 2.33%. Mainland Chinese stocks were higher on the day, with the Shanghai Composite up 0.84% to 3,596 points, while the Shenzhen component advanced to 1.58% to 15,269 points. The Hang Seng Index in Hong Kong rose 0.87% as of its final hour of trading. In Japan, the Nikkei 225 fell 0.957% to close at 28,242 points, while the Topix Index slipped 0.6% to finish its trading day at 1,845.49. Over in Australia, the S&P ASX 200 declined 0.78% on the day. And in the U.S., stock futures began the week in the negative territory. Futures ties to the Dow Jones Industrial Average declined 0.17%, while S&P 500 and Nasdaq futures declined 0.15% and 0.12% each. Stocks fell on Friday to close out a tough week as traders weighed President-elect Joe Biden's $1.9 trillion stimulus plan, along with the latest earnings from some of the biggest U.S. banks. And on the global oil market, prices fell further in early trade today from 11-month highs touched last week, ending a rally that started at the end of October on production cuts and strong Chinese demand, with the market's outlook questioned as coronavirus infections rise. Brent crude fell 0.5% to $54.79 a barrel, while U.S. oil was down by 0.4% at $52.15 a barrel, having declined 2.3% in the previous trading session. The benchmark had rallied in recent weeks, buoyed by the start of COVID-19 vaccine rollouts and a surprise cut of crude output by the world's biggest oil exporter, Saudi Arabia. U.S. shale producers have quickly responded to market gains in recent years, winning market share as Saudi Arabia and other major producers such as Russia have cut production in an attempt to support global oil and gas prices. And in metals, market prices dropped to their lowest in 1.5 months earlier today as a stronger U.S. dollar made bullion expensive for other currency holders despite expectations of a large COVID-19 relief package in the United States. Spot gold fell 0.3% to $1,820 an ounce, while U.S. gold futures eased 0.7% to $1,816 an ounce. The U.S. dollar strengthened to its highest in 4 weeks against rival currencies. Among other precious metals, silver fell 0.6% to $24.57 an ounce. Platinum rose 0.4% to $1,078, while palladium shed 0.2% to $2,377 an ounce. And when we come back, we look at other developing stories across the African continent. So do stay with us. And latest data released by the Ghana Statistical Service shows that the consumer price index for December has increased to 10.4% from 9.8% recorded in November. On a month-on-month basis, inflation between November 2020 and December 2020 was 0.9%, and average year-on-year inflation for the year stood at 9.9%. Food and non-alcoholic beverages registered an inflation rate of 14.1%, while non-food inflation came in at 7.7%, a decrease from the 8.3% recorded the previous month. The increase in food inflation was due to increases in the price of vegetables, followed by fish and other seafood. For non-food inflation, after a few months of high inflation for transport, December saw low inflation for transport at 4.8% year-on-year and 0.1% month-on-month, compared to an average 7.8% year-on-year and 0.4% month-on-month for the year. And Kenya's fuel cost levy has hit a 13-month high, setting the stage for an increase in power bills for households and businesses grappling with COVID-19 economic fallout. The Energy and Petroleum Regulatory Authority, in its latest data released, shows that the fuel cost charge for January is 2.58 shillings per kilowatt per hour, the highest level since December 2019, when it was 2.65 shillings per kilowatt. The rise came a day after the energy regulator increased diesel prices by 4.57 shillings per litre, directly affecting the cost of producing power in the subsequent months. Kenya's economy relies largely on diesel for power generation and transport, and global increments in the cost of product directly hits households and businesses. And South Africa State Power Utility Eskom says that a nationwide phased power cut, which was to end on Sunday, will resume today because some generating units were not yet operational. According to Eskom, as the return to service of some generation units had been delayed, Stage 2 load shedding will be implemented. Meanwhile, the eThekwini municipality has blamed load shedding for crippling water operations in several areas in Durban. This comes as the water supply to parts of Chatsworth, south of the city, was restored last Thursday, 1 week after taps had run dry because of a pump that had malfunctioned. And staying in South Africa following a 5-month lockdown, the country was easing domestic travel restrictions, allowing hotels to reopen. While international borders were still closed, the government put its hopes on domestic tourism. Let's see this.
South Africa remains among the countries hardest hit by the pandemic. And with recession-battered consumers watching their pocketbooks, many in the sector expected an uphill battle. The V&A waterfront in Cape Town is normally abuzz with tourists from around the world, but it remained empty in August, with just a few local customers coming in now and then to enjoy the city's scenic views.
Yeah, if you look around, it's really quite sad. I mean, this would normally be a bustling part of the waterfront. And Robert Allen would be running queues. But, I think the opportunity for locals now is that, this offer is going to be available without the queues, without the busyness.
Abundant wildlife, stunning scenery, and renowned vineyards have made South Africa one of the world's iconic long-haul travel destinations, establishing tourism as a pillar of the economy. Last year, it welcomed over 10 million international visitors. SA Tourism, the sector's marketing agency, was targeting 8.7% year-on-year growth in inbound arrivals in 2020, with total tourist spending projected to reach 273 billion rand. But COVID-19 brought the sector to a screeching halt as governments closed borders and imposed lockdowns. To cope, many businesses laid off staff or slashed wages. Others have gone bust. According to SA Tourism, nearly 440,000 tourism jobs are at risk this year. The sector is expected to lose 75% of projected revenues and 80 billion rand in foreign receipts.
The closing of our borders has impacted us because 70% of our tourists are international, especially in the Safari Lodge properties. So at this point, those properties are not being booked at all. Local tourism really in Cape Town it can survive, but it's at a hugely reduced rate. So for us, we really are opening just for the purpose of keeping our staff employed.
When the pandemic struck, South Africa was already in recession, The economy is projected to shrink by 7.2% this year, and widespread lockdown layoffs have added to a pre-COVID jobless rate of 30%.
And demand for chocolate has fallen in the US and Europe, and that's causing havoc in countries like the Ivory Coast, where cocoa bean producers find prices are falling and their stock is unwanted. This report shows that a dearth of beans buyers due to sluggish global demand is forcing some Ivory Coast farmers to sell their beans below the guaranteed farm gate price so as to reduce stocks piling up in their farm warehouses.
People in the United States and Europe are eating less chocolate, and the impact has been felt thousands of miles away in Côte d'Ivoire. The West African country is a major producer of the key ingredient, cocoa. Now unsold beans are piling up with around 100,000 tons stranded in the bush.
Pour vendre notre CCAO cacao, on a aussi problème encore.
We're having problems selling our cocoa because potential buyers say they can't pay 1,000 FCFA per kilo and sell it back to the Lebanese buyers for the same price. I am really worried my products will remain unsold.
With prices fixed at a minimum of $1.82 per kilo, this farmer is afraid buyers simply won't be interested. The bottleneck follows a request from chocolate buyers in Europe and the US for a delay in deliveries. Companies including Mars, Hershey and Barry Callebaut all buy from Côte d'Ivoire. Now, trader Alfred Yao says the downturn in orders is hitting livelihoods.
Le véritable problème aujourd'hui, c'est la liquidité.
It has a negative impact because the day before yesterday, we saw students in the streets because their parents did not find buyers for their cocoa. So they did not have money to send their children to school. On the field, the cooperative also needs to sell. If we don't manage to sell or if we don't manage to buy, we're stuck. If it doesn't work, it's because the money can't reach us.
With beans piling up at ports too, regulators are trying to stem the flow of products from growers. While eating less chocolate might be good for consumers in the West, the downturn is a bitter medicine for African farmers.
And that's a wrap on the program. Thank you for watching. I'm Chimeze Obi Iwago.